Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
You know, we hear it all the time. Companies talking about going green. They're making all these big commitments to cut emissions, shift their energy sources.
Right, achieving net zero. It's on every corporate homepage these days.
Exactly. But for you, the person who has to actually look at the budgets and make the business case, the crucial question is always the same one. How do they pay for it?
That is the critical link, isn't it? Because behind every single one of those commitments, whether it's a new solar farm or an electric truck fleet, there's a corporate finance team. And they're the ones who have to decide what passes muster, what's too expensive, and what actually delivers a real long-term financial return.
Okay, so let's unpack that. Let's get into this whole financial ecosystem. We want to move past the general ESG buzzwords and really dive deep into the specific financial mechanics.
Absolutely. Our mission today is really to give you a shortcut to understanding that toolkit. We'll look at everything from specialized debt like green bonds to performance-based loans, SLLs. We're going to show that sustainability isn't a PR effort anymore. It's become a core financial strategy.
And the pressure is just immense, right? It's coming from everywhere. You've got regulation, investors who are demanding it, consumers.
And just basic long-term economics. Corporate finance teams now have to manage climate risk just as seriously as they manage, say, currency risk.
So let's start with the definition. When we say sustainable finance, what exactly are we talking about?
We're talking about financial decision-making that explicitly bakes in environmental and social factors right alongside the traditional profitability model.
So there's more than just buying some carbon offsets.
Oh, far beyond that. It includes huge capital expenses, think electrifying entire corporate fleets, massive green building retrofits, investments in nature-based solutions. It's all on the table.
You said it's tied to financial performance. Before we get into the tools, can you just nail down that connection for us? How does a green investment directly hit the bottom line today?
Okay, look at it through just two lenses, cost and risk.
Okay.
Energy efficiency, something as simple as installing LED lighting or retrofitting old equipment that delivers measurable operating cost reductions instantly.
And the risk part?
On the flip side, companies with carbon-heavy models are getting hit with penalties, carbon taxes, new regulations, and maybe more importantly, investors are now rewarding credible transition plans because they signal reduced future risk.
So the message is pretty clear then. This isn't charity. If you fail to invest in the transition now, you're essentially just baking in higher costs for yourself down the road.
Precisely. It's proactive risk management. And it requires some pretty unique ways to fund it.
Okay, so that's the why. Let's get into the how. What capital tools are finance teams actually using to pay for everything?
We can start with the most traditional one, which is just internal capital. Classic CapEx.
So just allocating the standard budget toward projects that have a clear, quick payback.
Exactly. Efficiency projects are the perfect example, and the scale can be just massive.
Like the Walmart example.
The Walmart example is perfect. They invested heavily in energy efficiency LED retrofits, low-carbon refrigeration across thousands of stores, and those efforts, just focused on efficiency, saved them over $1 billion.
$1 billion in annual energy costs.
A pure financial return delivered through a sustainability strategy.
That's a pretty compelling case for CapEx. But what happens when a company needs to go outside for funding for these huge dedicated projects? That's where we get into specialized debt, right? Like green bonds.
Green bonds are probably the most prominent tool for that. They work just like a regular corporate bond, but the money, the proceeds are strictly ring-fenced.
Ring-fenced, meaning what?
Meaning that capital can only be used for eligible environmental projects. For the investor, it's totally clear their money is financing a new wind farm or a green building.
And is it actually a better deal for the company issuing them? I mean, is the borrowing cheaper?
Often, yes. Because they attract this specific huge pool of ESG-mandated capital, which drives up demand.
Right.
Apple is a great case. They issued multi-billion-dollar green bonds for renewable energy and low-carbon design in their supply chain. And the data showed they got a lower weighted average cost of capital for those projects.
Cheaper money for greener projects. Simple as that.
Exactly.
Okay, but this is where it gets interesting, because not all financing is tied to a specific project. We need to talk about sustainability-linked loans, SLLs. How are they different from a green bond?
The key difference is flexibility. With an SLL, the funding doesn't have to be used for a specific green project. It can be for general corporate purposes.
Okay, so where's the sustainability link then?
The link is in the interest rate. The rate is tied directly to the company's performance against predefined sustainability targets, their KPIs.
Ah, so you get a regular loan, but if you hit your goal, say, you reduce Co-Euro's emissions by X%, you get a discount on your interest rate.
Precisely. You get rewarded financially for your operational success. Schneider Electric did this. Their interest rate drops only if they hit their climate and energy KPIs. It's brilliant because it ties finance directly to operations.
So for a finance team, it's flexible, and it provides this ongoing incentive to be greener. I can see the appeal.
It's huge.
Fascinating. So we've got dedicated debt with green bonds and performance-linked debt with SLLs. Let's shift gears a bit away from raising capital to managing costs through power purchase agreements, PPAs.
A PPA is a really smart financial tool. It's a long-term contract, usually 10, maybe 20 years, to buy renewable energy from a producer at a fixed price.
And the benefit there is stability.
Exactly. It lets a company lock in their energy prices so they're not exposed to the wild volatility of fossil fuel markets. And, crucially, they meet their net zero goals without the enormous upfront capital expense of building the wind farm themselves.
This must be huge for industries with massive power needs, like tech.
Absolutely. You see Meta and Google using PPAs constantly for their data centers. In that world, predictability is everything. They stabilize their energy costs and reduce their carbon footprint at the same time.
Okay, last tool in the toolkit. We have to talk about carbon offsets. It's probably the most controversial area, right? The one that attracts the most criticism about greenwashing.
It is, and it has to be approached with extreme rigor. The finance team's role here is absolutely critical. They have to do intense due diligence, evaluate the quality and the permanence of the offsets, and then analyze the cost versus just abating those emissions internally over the long run.
So they're treating an investment in, say, reforestation with the same scrutiny they'd apply to building a new factory.
That's the only way to do it right. Microsoft is a great example. Their goal is to be carbon negative by 2030.
Right.
Their finance team analyzes the ROI on high-quality carbon removal credits, like direct air capture, with the exact same rigor as any other multi-million-dollar CapEx decision.
So we've seen the toolkit. Now let's see it in action. Let's talk about some case studies, starting with a real transformation story, or Faded.
Ørsted is a massive success story. They went from being this fossil fuel-heavy national utility to the world's leader in offshore wind. And to do that, they had to divest old assets and raise huge amounts of capital, which they funded in large part through green bonds.
And the market loved it. Their valuation just skyrocketed.
Yeah.
But let me ask the tough question. For every Ørsted, what's the risk? What if a company uses green bonds, but the technology they bet on doesn't pan out?
That risk is very real. It's why the finance team has to stress test their whole plan. Ørsted succeeded because they moved early and aggressively and basically cornered the market. Companies that wait too long risk being left with stranded assets and, much higher borrowing costs down the line.
That makes sense. Okay, let's look at another sector. Ford is using these tools to fuel their huge EV transition.
Right. Ford issued a $2.5 billion green bond tied specifically to EV development. The F-150 Lightning, battery investments. It was a clear signal to the market, which reinforced their credibility and gave them access to cheaper financing.
And then you have a company like Amazon, which is dealing with logistics on a global scale. They have to use everything at once.
It's a total blend. They use PPAs for their data centers and warehouses, they install solar on-site, and they're investing billions to electrify their delivery fleet. It's a masterclass in diversified sustainable financing, all tied to efficiency and long-term cost savings.
So we've covered the what's and the how. But the job for the finance team always comes down to proving the return. How do they actually plug these, sometimes intangible benefits into their standard investment models? What does the ROI framework look like?
They really look at 5 key pillars of financial return that have to be modeled, and it often starts with the net present value model.
Wait, let's just quickly define that for the listener, because NPV is so central here.
Sure. Net present value, or NPV, is just how finance teams weigh long-term gains against immediate costs, by accounting for the time value of money. When they model green investments, they look at 5 factors that really boost that NPV.
Okay, pillar 1, cost savings. That one seems pretty straightforward.
It is. It's measurable, fast ROI. Comes from energy efficiency, waste reduction. It hits the profit and loss statement immediately.
Pillar 2 is risk reduction. This is where it gets more interesting.
This is arguably the most powerful pillar of all. These initiatives, they drastically reduce a company's exposure to regulatory penalties, carbon taxes, supply chain problems.
All the stuff that keeps the CFO up at night.
Exactly. And what's fascinating in pure finance terms is that sustainability actually reduces the company's risk beta.
That's a huge insight. A lower risk beta means you can use a lower discount rate when you're calculating future cash flows.
Exactly right. Lower risk makes future cash flows more certain, which translates directly into a higher valuation for the entire company. Sustainability is a valuation enhancer.
Okay, pillar 3, access to capital. We touched on this with green bonds.
It's about both access and cost. A strong ESG story attracts more investors, which leads to cheaper borrowing. And this directly impacts the weighted average cost of capital, or WACC.
Let's pause on WACC because that's another huge financial driver. For you, the listener, we're talking about the total blended cost a company pays to finance itself. How big of a difference can being greener make there?
It can be a significant competitive advantage. I mean, if your competitor is paying 10 or 20 basis points more on their debt over a decade because they don't have a credible plan, that gives the green mover a decisive edge in capital efficiency.
Pillar 4. Revenue growth. So you're saying this can actually open up new revenue streams.
Absolutely. It creates opportunities for premium pricing, it lets you access new customer segments who care about this stuff, and it future-proofs your products.
And finally, pillar 5, the one that's hardest to stick in a spreadsheet, intangible value.
Right. Brand equity, attracting top talent. They're hard to quantify, but they contribute profoundly to shareholder value. Finance teams now have to model how all 5 of these pillars influence their analysis.
So let's bring this all together. What are the final takeaways for you listening to this and navigating this landscape?
First, sustainability is no longer just a report. It is a core financial strategy. Second, tools like green bonds and SLLs are mainstream, and you have to see them as competitive advantages.
And
Third, finance teams must rigorously model both the costs and the long-term benefit of risk reduction. And fourth, remember that the most reliable ROI often comes from efficiency and cost savings.
And finally, I'd say capital allocation now requires real sustainability expertise. It's becoming a core part of the job.
And that leads to a final provocative thought for you to consider. We've shown that sustainability can measurably lower a company's financial risk and give it cheaper access to capital. So if that's demonstrably true, doesn't delaying these investments effectively make a company less financially competitive and ultimately more unstable in the long run?
Answering that question is now central to long-term viability. The first movers get the lower energy costs, the cheaper financing, and the investor confidence. The late adopters just end up paying a higher price.
Stay analytical and keep leading the future of finance.
Until next time, we hope you take this deep dive and apply these powerful financial strategies to the fields you are exploring.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.